we should step back before we start talking about their current role, is look back the role that they've played and how they've evolved. Dart pools are not a new thing. They've been around in the US in particular for around 12 or so years. But even before that, prior to them getting the name of dart pool, they existed. They just went by a different name, and that was the institutional, basically the broker-dealer or sales trader, or what was commonly known as the upstairs market. And that's when institutions who have very large transactions to make, they would call a broker, and that broker would then call around other clients that he has, trying to find the other side of that trade. And that was called the upstairs market, and it's existed for years, and you've heard the term specialists in the US, and they did exactly the same thing. They would know where to go to hunt down that liquidity. Now, obviously, as the markets have become more complex, it's very, very difficult to do that, even more difficult to do that. So then you saw the involvement through advances in technology, whereby dart pools, and specific to Liquidnet specifically, we look to connect large institutional investors with other institutional investors. And why do they want to do that? Well, the reason why institutions want to do that is because, one, typically if they go to the current lit market or the exchange, in most jurisdictions it's just the exchange, they can't find the kind of liquidity that they need to satisfy their demand. So they have to hunt around for other sources of liquidity. Now, if they can find that liquidity in a way that they're not leaking any information to the market, because if information leaks out that there's a large buyer or seller of a stock, that naturally impacts the current price of the stock and the ultimate price that they'll receive, either buying or selling. So it's first things first is around liquidity. The second one is reducing their market impact through reducing information leakage. And thirdly, in Liquidnet, 80% or so of our transactions happen at the midpoint, which means that they're actually getting an even better price than what they would get if they went to the current lit markets as well. So it's really three things as to why they do it. And they're really just trying to solve some of those fundamental problems that they have, being an institutional investor, trying to find size and reducing market impact and improving that price that they get for their end investors. And their end investors are the collective retail investors who are investing in markets through mutual funds, pension funds, hedge funds, collective investment schemes. I guess a lot of as mentioned, dart pools have largely been misunderstood. It's taken a long time for the likes of us, and with the help of the press, to educate the benefits of dart pools and what they do. There are many different types of dart pools there, and I think it's important to understand the differences. At one end of the spectrum, you have that's known as the broker internalisation engines, which what they're doing is really trying to cross up as much of the flow, the different types of flow they have, which could be high frequency, algorithmic, their client flow, their proprietary trading flow, their index arb flow, all different types of flow. Now, what that normally means is that the average execution size is really no different to what you find on the exchange. So it's making it more efficient for that broker, but is it really benefiting the overall market? There's questions around that now, and there's lots of regulators looking at what the right market structure and regulatory framework should be for dart pools. Whereas at the other end of the spectrum, which is us, you're offering much larger execution size, and also in terms of performance as well. It is fundamentally improving the performance that our clients receive and then pass on to their clients. And what you've seen in the US and through MiFID in Europe and in Australia now is the regulators coming out and saying the need of the institutional investor is different to the need of the retail investor. They need to be able to transact when they have a large institutional size order. They need to be able to protect that order by not displaying it to the entire world, because that's just not practical, not feasible, and not how things have been done in the past and will not likely be in the future. So their needs are very, very different. So, what's good and what's bad in dart pools, it's open for debate. In terms of gaming and policing, it's obviously that keeping the integrity of the dart pool is very, very key. We take it very seriously within our community. We have quite strict entry rules as to who can come in and who can't. It is very much focused around the buy side, so the large institutional investor, and we keep very close tabs on their behaviour. And if people are not playing by the rules that have been largely defined by the community, not necessarily Liquidnet, we will work with them to figure out why. And if ultimately they can't improve or abide by those rules, then we'll ask them to leave. And we've done that on a number of occasions. So we take it certainly very seriously. And as technology evolves as well, you can put further layers of monitoring and surveillance and technology on top of that to make sure that there is no bad behaviour within your pool. If there is, then at least you can find it and address it and weed it out. I think they've got. I mean, they're still a relatively small portion of the overall market share. I mean, dart pools. I mean, we've been operating now in Asia for 3.5 years or so. We're one of the first that really gained any traction. But you have to put some relevancy on it. I mean, Hong Kong have now been tracking what's being executed in a dart pool since they changed some of their reporting requirements, and what that means is they now have a very firm picture as to what is being executed in a dart pool and what's not. It's still anywhere between 1 and 1.5% of the overall market volume. That's pretty small. If you look at what's happened in the US is anywhere up to 15%, and in Europe between 10 and 12, or maybe a bit higher. So there is still a long way to go, but I think what you've seen in the US and Europe, volume doesn't move from the lit space to the dark space very quickly. It takes time. It really does, over a gradual period of time. What you do see, though, is when competition comes in directly with the exchange, you see volume shift from one venue to another, often very quickly. You saw that in Europe, where Chi-X is now running. They have 40% market share in certain markets, which is very high. You've obviously seen now in the US and in the US in particular, New York Stock Exchange and Nasdaq, they lost a huge amount of their volume. Up to 75% of their volume moved to other trading venues because they were faster and they were cheaper and they had more depth in their product. That's now changed, and you've seen the balance redress where you've seen volume come back to their exchanges as they've caught up. But how much volume actually ends up moving to the dark side, if you like, it takes time, and it's never going to be I don't think, the size that people often feared it would be.